Hi everyone, and thanks for joining us today for our portfolio construction webinar, part of our series designed to help you see wealth differently and hopefully spot new opportunities. My name's Liam and I'm from the marketing team here at NetWealth, and today we're delighted to have John Owen join us from MLC, who's going to be sharing how to manage your portfolio through changing market conditions, which is especially relevant given the sort of levels of volatility that's going on around the world at the moment. Before I hand over the controls to John, let me just run through some quick housekeeping items. First of all, for financial advisors who are joining us today, one CPD point is allocated for joining the session. To receive this point, you'll need to be online for at least 30 minutes, and then you'll receive your CPD details within the next week. Like always, this webinar is being recorded, so everyone who's online today and who registered will receive a copy of the session and slides also within the week. And if you have any questions for John throughout the sessions, please ask them in the question bar to your right. There's a question panel. Please ask them, and at the end of John's presentation, we'll save 10-15 minutes to get through as many as we can. Please be aware that the information shared today is general advice only and is not intended to be professional financial advice. For those who don't know a lot about us, here at NetWealth, we're an ASX listed company nearing our 20th year, and our purpose is to help Australians see wealth differently and discover a brighter future. We provide investors with a range of investment and super solutions via our online platform. Investors can manage their super investments using our portfolio tools, access a range of reports and online charts to analyze your portfolio, and stay up to date with changes in the market by accessing live prices and charts on individual stocks. Our platform also supports financial advisors with a range of financial products and services to help manage their clients' investments and super. As mentioned, we're delighted to have John Owen join us today. John is a portfolio specialist at MLC Asset Management, specialising in Australian shares and property securities. He joined MLC in 1994 to research Australian shares and listed property managers for MLC's portfolios. And for the past 15 years, he has been responsible for communicating with advisors, research houses, and investors on the investment approach and portfolio strategies of MLC and NAB Asset Management. But today he is your webinar presenter, so please, John, take it away.
Thank you very much, Liam, and good afternoon, everyone. It's fantastic to be with you. A big thank you to our friends at NetWealth for inviting us to be part of your afternoon. We are hopefully going to cover a lot of interesting topics for you today, but before we launch into that, we also have our obligatory general advice warning as well. Just a reminder to you that I'm not a licensed financial advisor, so I'm not licensed to give advice. But what I can do is give general information, and hopefully in the next 45 minutes or so, that general information you find useful and interesting as well. So let's just cover the agenda today that we propose to follow with you. As Liam suggested, there is always a lot going on in investment markets, and there's plenty to talk about. So for the first few minutes, we thought it would be good to go through some of the major events occurring in markets and the general economy. And then we'll start to tie in the management of portfolios to the investment world that we find ourselves in. So perhaps a couple of suggestions from us in terms of how to manage changing market circumstances in building a well-diversified portfolio. And that diversified portfolio can sometimes entail including assets that we call alternative assets that are very different to traditional ones like shares and bonds. So we'll give you one or two examples of that. As always, there's plenty of investment funds for investors to choose. So we'll do a quick session also on which fund for which investor. And then finally, giving you our thoughts on how to select the right manager for your investment arrangements. So here we go, and as Liam said, we will have time for questions at the end as well. So let's move on to the first slide that we're showing here. And this is a slide that goes back to 2006 through to the present. And what those red and blue lines are measuring or showing through that period of time is the growth of the global economy, which is the blue line, and the economic growth of Australia's economy, which is the red line. And we're measuring growth relative to the left and right-hand scales as well in percentage terms. So what is interesting is that there is still certainly growth in both the global and Australian economies, but there's been less of it in about the last couple of years. And you can see that over on the extreme right, where the downward sloping lines are indicating that growth has slowed, certainly in Australia. So after a promising start to 2018, global economic growth certainly has slowed, as you can see there. And I'm sure you can draw your own conclusions about what has caused that. But the various factors that we think were the catalysts for this slowdown, amongst others, were the decision by America to continue until recently to raise interest rates. Obviously, the escalating trade war that we see between the US and China. And just on that, it's worth remembering that the dollar value of trade between America and China that is currently subject to tariffs is actually a very small percentage of the total global trade. But unfortunately, what this trade dispute has caused is considerable uncertainty, and that's been very, very damaging. And also the impact it's had on sentiment, and companies that we see globally and locally are perhaps choosing to defer their investment spending. So this trade war, even though it may appear just to be between the US and China, certainly has had global ramifications. And we'll talk a bit about that in a moment as well. We also have the obvious geopolitical risks, such as Brexit, which is fast approaching. The 31st of October is the final date. And of course, problems within the Italian financial system and budget deficits as well. So in the globe, there's probably a number of reasons explaining why global growth has trended downwards. You can also see the red line, Australia's economic growth. It certainly moved into the slow lane. The June quarter GDP numbers came out last week, and the economy to the end of June was growing at just 1.4%, and that's probably a 10-year low. So we're certainly back in the slow lane. And I think if the Australian economy had a report card, it would probably read, could do better. Let's move on to the next slide. And we're just looking in particular at the trade dispute between China and America, because it has had a pronounced impact on sentiment globally. Now, President Trump a couple of years ago said that trade wars are good and easy to win. Well, I'm not sure he would say that right now. But as we can see on the left-hand diagram, have a look at the black line, and this is from 1998 through to the recent past. America does have a trade deficit problem. It is spending more on imports than it is exporting to the rest of the world. And the key contributor to its trade deficit is obviously the immense net import bill from China. So that's at around about 400 billion, which is a little under half of America's total trade deficit. So that may help explain why Trump has targeted China to try and improve that trade deficit problem. Now, the trade war has been going on for quite some time. Around about 250, 300 billion in imports is now subject to tariffs. And it seems to be on again, off again, and that's certainly a source of uncertainty in markets. And at that point, I'll draw your attention to the blue line in this left-hand diagram. The other major source of trade deficit that America has is its trade with Europe, to approximately $200 billion US. And there is concern or uncertainty that at some point Trump will turn his attention to the Europeans in an attempt to try and fix that aspect of their trade deficit problem. So there are widespread concerns, for instance, that Trump will impose tariffs on European car imports, and that perhaps helps explain why some of the European share markets have had a fairly dismal year so far because of that uncertainty. And this uncertainty, if we can look at the right-hand diagram, this uncertainty is certainly showing up in some of the key business surveys in Europe, and also, I might add, in Japan, which are two of the world's greatest export zones. So those downward sloping lines over the last couple of years are indicative of greater uncertainty coming through the Purchasing Manager Index manufacturing surveys. So clearly European manufacturers, and also in Japan as well, are sharply lower for the last couple of years. And again, we suspect that that is because manufacturers in both those regions are alarmed that the trade war between the US and China could potentially penalise their own export opportunities for their particular products. So that source of uncertainty is particularly unhelpful. Let's move on to the bond markets and what has been happening with interest rates. And I have to say, we're seeing some astonishing developments within the global bond market in this low growth, low inflation world that we're in. And that's certainly evident from the left-hand diagram, which is measuring the yield on various 10-year government bonds from 1990 on the left through to the recent past. And you can see there's been a substantial shift through that period of time from high yield through to very, very low yield bond in the last few years. And that is because the inflation environment is particularly low and also much slower growth as well. We're even at the stage where we are actually seeing various bonds trading at what we call negative yields. So the purchasers of those bonds are actually quite happy to purchase the bond, knowing that when their bond matures, they will get less of their money back. So we are seeing some astonishing developments. It's interesting to note also, there are now only 5 countries, the UK, the US, New Zealand, Canada, and Australia, where all of the government bonds that are currently on issue are providing a positive yield. So that's quite astonishing. And such low, or in parts of the world, negative yields imply low economic growth and very low inflation will probably persist in the coming years. Now let's focus our attention on what's been happening in the US interest rate environment. And what we can see from the black line in the chart on the right is the progressive increase in US interest rates over the last 3 years, where the US Federal Reserve, to try and keep inflation under control, have been progressively raising interest rates. But we've seen some astonishing developments in the last 12 months, where this time last year, the US Federal Reserve was warning the market that it will continue to raise interest rates. Now, in response to a lot of market nervousness that those comments created, early in the new year, they suggested they would leave interest rates on hold and be fairly patient about increasing interest rates further. And then barely a few months later, as we saw, the US Federal Reserve starting to reduce the cash rate, which is quite interesting. Now, the red line is implying that markets pricing of bonds in the futures markets, the markets are assuming that the Federal Reserve will continue to reduce interest rates down to about 1%. However, we think that that's unlikely. The financial markets may be running on exaggerated expectations, and that's because the US economy continues to grow and the American consumer is also in a very strong position and in good shape. They're enjoying higher wages and lower interest rates and low inflation. So, in other words, there's probably no real urgency for the Federal Reserve to substantially reduce interest rates from where they currently are. And I guess that does raise a little bit of concern that the markets are expecting more than the Fed may actually provide in the way of further interest rate reductions. Now, let's move on to some things in Australia, and let's examine some of the reasons why Australia's Reserve Bank has begun to reduce the cash rate that we've seen in the last couple of months. And one of the very strong reasons they've done that, as we can see on the left-hand side of the diagrams, that there is a lot of spare capacity in Australia's labour market, and that is, as a result, constraining wages growth. Now, a measure of spare capacity in the labour market, and you may have read about this in newspapers because you do see it quoted more than in the past, it's what we call the underemployment rate. And this is a measure by the Australian Bureau of Statistics of spare capacity in the labour market. And basically what it's measuring are the percentage of the labour force that have a job but are working fewer hours than what they would prefer. So a lot of Australians in part-time work, but they want to work full-time. They're working 20 hours a week, but they want to work 40 hours a week. And that's what's called the underemployment rate. And if you actually add the underemployment rate to the unemployment rate, which is currently around about 5.2%, as you can see on the right-hand scale, with the underemployment rate at about 8.2, add on unemployment at about 5.2, you've got about 13.5% of the Australian workforce that in one form or another are underutilised. And as you can see with the blue line, that that spare capacity is constraining wages growth in Australia. The most recent annual change to the end of June for wages growth in Australia was 2.3%, and that's clearly substantially less than what it was, as you can see over on the left, at around about 10 years ago. And this very modest gain in wages can probably help explain why Australian consumers have been as cautious as they have, and why retail spending has certainly been under pressure. So obviously the Reserve Bank would like to see higher wages growth than what we have seen so far. For both workers and savers, let's all hope that we have seen the turning point in wages growth. Now, the other thing that's concerning the Reserve Bank, and I'll draw your attention to the chart on the right, is that the average Australian household is now one of the most indebted in the world. And that's why perhaps we're seeing consumer behaviour as cautious as it has been, because the average Australian household carries a lot of debt. So have a look at the blue line, the upward sloping blue line, We're going back to 1988 through to the recent past. If you go back to 1988, that blue line is suggesting that for every $60 of debt that their household has, it had $100 of disposable income to service that debt. Now, as you can see through time, that upward sloping blue line has more than reversed those relativities. And today, around about $200 of debt per $100 of income is the norm in many households. So we can see a much higher level of indebtedness in the average Australian household. And at a time of low wages growth, that's certainly constraining a lot of households who probably, like yours and mine, are also facing much higher utilities bills like electricity. So let's just move on. Another area why the economy needs a helping hand is because many of the business and consumer related surveys that we see are suggesting that both households and businesses are lacking confidence in the immediate outlook. So, for instance, we've seen car sales fall for about 14 or 15 consecutive months. Consumer sentiment surveys are fairly negative, and businesses are investing, but doing so very, very cautiously. So these subdued economic and financial indicators that are summarised on the left-hand diagram suggest that there may still be pressure on the Reserve Bank to reduce interest rates further. One other area of concern for the Reserve Bank is that on the right-hand diagram, small businesses are reporting in various surveys that they are finding it more difficult to obtain finance. So lenders like the banks are increasingly cautious in their lending practices, rightly or wrongly, towards smaller businesses. And probably part of that reason is that property is a common form of security for small business lending. Banks are lending to small businesses, but it's usually property that is the security offered. And around about 50% of loans to small businesses are secured by residential property. So perhaps that's why small businesses have been struggling to gain access to finance, because as we can see in a moment, house prices or residential property prices have been falling. Now you can see on the bottom right of that right-hand diagram a sharp improvement in access to lending, and that is perhaps partly because, as we can see on the right-hand diagram, no longer are we seeing residential property prices falling, that there's actually been a small uptick recent in the last couple of months in both Sydney and Melbourne prices. So that perhaps is very positive in a number of ways, not just to help small businesses gain better access to lending, but it may also improve people's sense of wealth and hopefully lead to more consumer spending. But we don't think the property sector is out of the woods just yet, because if you look at the left-hand diagram, this is measuring the annual growth in lending for housing to both owner-occupiers, the blue line, and investors, which is the dotted red line. And you can see dramatic falls in both of those, especially lending to investors. Now, that's probably partly because banks themselves and also regulatory authorities like APRA are requiring banks to be more cautious, if you like, in their lending to investors in property, but perhaps because also of the fall in property prices, that investors have also moved to the sidelines. So some very interesting developments that have occurred in certainly in the property market. Now let's move on to a more investment flavour now. And this slide is showing the returns of various asset classes from Australian shares on the left, right over to cash and the Australian dollar on the right, in various periods to the end of August. So we're looking at the 1 year, 3 years and 10-year periods to the end of August. So they're fairly recent numbers. I could probably make a few summary comments for you. Despite the recent volatility, certainly the last December quarter last year was pretty negative. It's interesting to cast your eye across that diagram and see that despite that volatility, over the 1, 3 and 10-year periods, and if I was to show the 5 and 7-year periods, it would tell a similar story, that returns have generally been positive right across the board. Over on the left, the Australian share market has delivered a very, very good return, just shy of 10% for the year, and it's successfully outperformed most, if not all, of its major global peers in the year to date. In the year to the end of August. And a couple of the important drivers of our share market have clearly been expectations of lower interest rates, which the Reserve Bank has delivered twice so far this year. And also in the resources sector, a substantially higher price of iron ore, which has been very, very beneficial to big miners like BHP, Rio Tinto and Fortescue. We've also seen many Australian companies pay special dividends in the last 12 months ahead of the potential change of government in the May federal election, which obviously didn't occur. In global shares, you can see that having an unhedged strategy was superior to a hedged strategy. So as you can see over on the extreme right, benefiting from the fall in the value of the Australian dollar. So that's why unhedged global shares has done well. The star performer is the one in the centre, which is Australian property securities. And that sector of the Australian share market has gone up nearly 20% in the last 12 months. Now, it's not just been because commercial and industrial property fundamentals have been quite positive, but it's because in a low interest rate environment, Australian property securities have been targeted by income-seeking investors because the distribution yield of Australian property securities is somewhere between 4 and 4.5%. And as I'm sure you'd appreciate, that looks pretty attractive compared to some of the government bond yields that you can see, and certainly compared to the term deposit rates that are being offered around as well. And just finally, you can see also some very strong returns from Australian and global government bonds. Now, I will just come back to one of the reasons why the Aussie share market did so well, and that is because its dividend yield is clearly superior to the yield that you would get on a 1-year term deposit, which is the red line. So you can see through time, the Australian share market provides a dividend yield typically of somewhere between 4 and 5%. Let me explain what dividend yield means, and it's easy to calculate. Basically, it's dividing a company's annual dividend by the company's share price. So let's, for instance, say a company that is trading at $100 share price, it's paid $5 in dividends. So dividing 5 by 100 times 100 gives you 5%. So it's a pretty easy calculation. So clearly the dividend yield is much more attractive than what investors are getting from a bank term deposit. So that's also excluding the benefit of franking credits. So again, for people seeking income, Australian shares can certainly be a good sector to target. That's assuming, of course, that they can tolerate the ups and downs in the market cycle. Now, from a portfolio construction perspective, as we've seen, there are so many things going on in the macro world and in the investment world. We are typically in a very unpredictable world. And in such a world, we think you need to comprehensively assess what the future might hold, assuming that the future is uncertain. And the harsh reality is that there exist many possible futures that the markets could take and that the economies could take as well. And there'll be a mixture of positive and negative scenarios as well. So in a portfolio construction perspective, you really do need to spend a lot of time assessing where we are today and where could we be in the next 1, 3 and 5 years. And by thinking very carefully about that, it does put you in a much stronger position to be able to assess potential return for markets, the risks associated with generating those returns, and also the opportunities for diversification along the way. And along the way, you also have to take into account markets can be driven very strongly one way or another by investor behaviour. And I'm sure a lot of you can remember the tech boom, where a whole range of companies that had never paid a dividend, hadn't generated $1 of profit, and didn't have any sales revenue were valued more highly than old economy companies that were producing earnings and dividends. So in portfolio construction, it's very important to be able to develop insight into how the future may evolve. There's no point in waiting for the future to occur from a portfolio construction perspective and hoping to adjust your portfolio for those circumstances. It will probably be too late. So any investment process that is inherently forward-looking and is thinking about how different the world could be to where it is today is probably in a fairly strong position to be able to make those portfolio decisions today that are appropriate for the future world that could unfold. And you know what? There really is a very wide choice of future scenarios that you may need to think about in building a well-diversified portfolio. A good investment process has to imagine many different future scenarios and the probability of those occurring. So these are some of them that, that perhaps need to be thought about. There'll be some scenarios that are probably very unlikely. So you can see over on the right, up near the top, global depression, fairly unlikely, although it has happened once before. So you can't rule that sort of scenario out. Over on the left, on the same line, you can see protectionism. Could the trade dispute between China and America worsen? And could it lead to a rise in protectionism by a whole range of countries trying to protect their local industries? Financial collapse down the bottom left, that's where we were this time 10 years ago, just after the GFC or during the GFC. It didn't look a likely scenario 2 years earlier, but in 2008, it was a very real scenario that could have played out. And sure enough, the one in the middle, oil price shock, that is strangely topical, given that we prepared this presentation last week. Here we have a situation in the last 48 hours where somewhere between 5 and 6% of the world's oil supply has been taken out by the explosions at the refinery in Saudi Arabia. So again, I guess this slide is just emphasising in a portfolio construction perspective how broadly you need to think about how the world could evolve and plan for it before it actually occurs. Now, we wanted to spend a little bit of time just talking about what's the most appropriate fund or strategy for which type of investor. And this slide may help emphasize that fund choice actually is very, very important. Very simply, as you move from left to right up that active management scale, active management, and I guess in some areas a higher fee strategy, enables the fund manager to build a better diversified portfolio by having a much higher fee budget, and in doing so is probably in a stronger position to provide downside risk protection. So protecting against particularly negative scenarios. For a low fee strategy down the bottom left, that probably entails a fairly simplistic investment portfolio with perhaps more asset allocation constraints. That may not be an issue in positive markets, but the lack of diversification in that strategy, because the fee is low, may actually constrain the ability to protect against negative markets. So let's tease out those concepts right now. So what we're seeing here, let's assume you've gone to a financial advisor and you've said, this is my goal, I want $1 million by the time I retire. How are you going to get me there? Probably the starting point for any portfolio construction is producing a portfolio that you see on the right there. So some Australian shares, some global shares, certainly some bonds, Australian and global government bonds, for example, to protect against the risk of shares. And of course, Australians love property, so there's probably an exposure to Australian and global listed property trusts in there as well. So that's a fairly simplistic portfolio that has a little bit of diversification. In a rising share market, that portfolio will probably actually do very well for you, which is shown path one. So in a raging bull market, and certainly that's been the case in the last 10 years, that fairly simplistic portfolio will probably enable that investor to overshoot their goal. They'll end up retiring with more than the $1 million that they said they wanted to live on. However, that portfolio is fairly simplistic. It's not a very diversified portfolio. So when share markets don't do well or are in negative territory, you can see also potentially that investor could undershoot or underachieve their goal. So that investor may say to an advisor, look, I can't sleep at night thinking that I may undershoot my goal. What can you do about it? And the advisor would probably say, well, we can add more asset classes and strategies to your portfolio and improve the diversification of that portfolio. And through that diversification, that portfolio is probably in a better position when share markets are negative because there are more sources of return coming into that portfolio compared to the previous one. So as you can see, adding more bonds, including corporate bonds, investing in emerging markets, taking currency decisions, whether you're hedged or whether you're unhedged, and also adding some different asset classes, as you can see up the top. Insurance-related investments, an exposure to emerging economies, and maybe some private assets that we'll talk about in a moment. So that's a more diversified portfolio, and probably the fund manager who's managing that portfolio has more levers to pull to protect that investor when negative market circumstances are occurring. And that's, as you can see, path two is not as negative as the first path. But the client might say, look, I'm still not as close to my goal as I want. Is there anything else we can do? And the advisor might say, well, look, there are some funds that are more focused on generating an inflation plus return rather than trying to match the return of the underlying markets. And the way those portfolios are managed, they are usually more actively or more dynamically adjusted as market and economic circumstances emerge. So with a greater degree of activity by the underlying fund manager, in particular taking risk off the table if they see risk environment unattractive, the range of possible returns is a lot tighter than you would have seen in the first portfolio, which was relatively undiversified and had a much broader range of returns. So that type of strategy may make investors feel a little bit more comfortable having more diversification. But as you may be thinking, that may entail a higher investment management fee to be able to have a much bigger fee budget to diversify that portfolio better than the first one. So I guess the choice is yours. And we did allude to one of those different asset classes called private equity that we think probably should play a role in a well-diversified strategy. It's an interesting fact that there are actually a lower number of companies listed on global markets. What we find is that private companies are staying private for longer. And that's because there's a lot more sources of funding available today for those privately owned businesses who want to expand. So this is a very interesting asset class. And it falls, some of the potential investments fall into two broad categories. Venture capital. So this is providing money to start up a new business. So we often say at work, find me the next Google, find me the next Facebook, providing seed capital to develop hopefully very, very successful companies. And there are also buyout opportunities. So these are buying existing companies that for whatever reason are underperforming their true potential. So spending money on the business, turning it around, improving its operating performance, and hopefully therefore being able to sell those investments at a much higher price. However, this is a sector that requires an investor having access to the world's best manager, because we can see on the left the difference between the best performing managers in these sectors and the worst performing managers are very, very wide. And we find that the most successful managers tend to have a virtuous cycle. The most successful managers in the past get access to the best deals first, and that tends to reinforce their performance superiority over smaller or less successful managers. So manager selection, as we see here, is a fairly key indicator of how successful you will, your strategy will be. And that's probably a good segue into how to select the best manager to manage your portfolio. It may surprise you that past performance isn't often a reliable indicator of manager skill. So what we're showing here, each of the columns, the coloured columns from left to right, represents the return of a global share manager relative to the global share index. So you can see those two managers over on the left, they appear to be performing very, very well. Their return, portfolio return, as we see here in the 3 years to the end of December 1999, are over benchmark by about 20% per annum. And you can see over on the extreme right, there are quite a few managers who are underperforming the global shares index quite dramatically. Now, if you believe past performance is a reliable indicator of skill and a manager's future performance, let's have a look, leaving all of those managers in the same order, where they sit in the 3-year period to the end of 2002. And that's what we've got. You can see that the 2 managers who were the most successful in the 3 years to 1999 on the left have become the worst performers, and the worst performers in that period over on the right are now the best performers. And you can see there's some blanks, managers missing in that 3-year period that there were 3 years before. We suspect that's because their returns were so horrible in that 3-year period that they no longer provided their returns to the manager performance surveys. So this is a good indicator of you can't really choose a manager based on their past performance. It says very little about their future performance. Now, before I move on, interesting period that we're seeing here. Some of you may remember the 3-year period to the end of 1999. That was the tech boom. And the 3-year period to the end of 2002 was the tech wreck. So if you can't use past performance as a reliable criteria to choose a manager to manage your money, how should you choose a manager? And we think you need to do a lot of research about what makes a manager tick and try and understand everything about that manager. So covering a broad range of issues, such as the stability of the manager's business. Do they have an investment philosophy, and do they stick to it? The investment team, how experienced is the team? How large is the team? Have they worked together for many years, or have they all come together in the recent past? And one that I haven't mentioned there that is also very relevant is the style of the manager. And we've seen over the last 10 years that what we call growth managers, and these are managers who are targeting businesses like Amazon, Apple, CSL in Australia. These managers have tended to outperform what we call value managers, who are looking to invest in cheap, unloved securities in the market. So style is also an important criteria to look at as well. So quite a lot of research that you need to do to truly understand a manager and whether their good performance is as a result of skill or is it a result of luck. So that pretty much brings us to the end of the webinar before we take your questions. Clearly, we're in a highly uncertain environment at the moment with some fairly incredible things going on in various parts of the world. Probably the best investment process to get you through what is usually and is always an uncertain world is to think about the future. What are the scenarios that we could find ourselves in the next 1 to 3 years, and how portfolios should be adjusted to address those potential opportunities, but the risks that may occur as well. It sounds old-fashioned, but investing broadly, being very diversified, is certainly a very, very good thing and potentially provides you with a smoother pattern of returns. And just finally, try and access experienced people, whether it's investment managers or whether it's investment advisors. As we sometimes laughingly say, perhaps it's a bit unfair to the university graduates listening, but you wouldn't want to let a recent university graduate manage your money. Think carefully about who you choose to help you make those important investment decisions. And that's certainly why, unfortunately, the majority of Australians should have access to good financial advice, but actually don't. So if you're working with a financial advisor, that's a very wise decision to help you manage your money in what is a very uncertain world. So I think I'll leave it at that. I believe this webinar is also being recorded, so those of you who haven't had time to get through to the end can listen to it, as Liam said earlier. I believe we do have time for some questions.
Yes, we do have some time for questions, so just a reminder to anyone who has a question for John, you can do so by expanding the question panel on your taskbar and typing in there. We'll get through as many as we can in the next 10 minutes. John, really good presentation, I must say.
Thank you, Liam.
Great overview of what's going on in the world, and hopefully the listeners have got some considerations of how to build their portfolio there.
Thank you.
So we'll start here with, we got a question from a listener saying he read recently, going back to one of your very first slides on the deficit with the US that was just focused on goods. And he read somewhere that if it took into account goods and services, then the trade US-China balance would be neutral or thereabouts. Is that true? And if it is true, then what's Trump really trying to achieve by having a bit of a tit for tat with China?
Well, no, good question, and you're obviously very well read. That diagram that I did show should take into account both manufactured goods and also trade in services as well. Now, as to what Trump is trying to achieve, well, it's debatable whether imposing tariffs is going to achieve that long-term goal. The problem with tariff protection is, and we saw this in Australia in the 1960s and 70s, if you're protecting your local industry, it takes away their incentive to be as efficient as possible in a global context. So protectionism can make local industries who receive that protection fat and lazy. And I'm not sure how happy the American consumer should be as well, given that the goods and services that will be imported from China are now much, much higher in price. So Mr. Trump obviously has his own theories about whether a trade war is good or not, but it's debatable whether, from a number of perspectives, it's a good thing.
All right, thanks, John. We have another question here. With all your sort of asset performance over the past 1 to 10 years, I think it's global unhedged was outperforming hedged.
Yes.
Do you expect that to continue for the?
Well, that's one of the great, the unknown unknowns, shall we quote Donald Rumsfeld many years ago. Predicting currency movements in the short term is always a fairly difficult thing to do. When the Australian dollar was at $1.08 compared to the US, or even at parity with the US, I'd have to say it was probably a fairly easy decision that the Australian dollar probably had more downside risk than upside potential. So in our portfolios, we have had a preference for unhedged global shares for quite some years. But as your questioner quite rightly points out or implies, that decision is getting harder and harder with the Australian dollar now down at around about 67, 68 cents. So the easy gains from being unhedged have probably happened, and it's getting a lot harder now in deciding the appropriate hedged unhedged ratio. If anything, in some of our portfolios, we've started to slightly increase our exposure to hedged global shares.
Great.
But we're still predominantly unhedged.
Yeah, no worries. How are you seeing a sort of an increase in the uptake of alternatives, and how are they sort of being used?
Yes, in a short answer, yes, but alternative strategies such as those that we use are not readily available to individual investors. And I know I might be singing from a very familiar hymn sheet here, but that's why quite often, rather than trying to build your own portfolio, it can be good to have some of your money in a large, well-diversified, professionally managed portfolio, because those larger fund managers, with the benefit of being able to pool lots of money, it provides good access for that manager on behalf of investors to those alternative managers and strategies, especially those globally. So we think that's a good part of a portfolio to include to help diversify the risk of share markets and providing alternative sources of return. There are some, I guess, specific funds that may give you a pure exposure to some of those alternative asset classes, but from my experience, you would probably tend to find large diversified funds are probably the best way to gain access to some of those specialist managers and portfolio strategies. I mean, we know some managers in the private equity space that unless you've got $100 million, they're not interested in talking to you.
Yeah, fair answer. Speaking of diversification, we have a question here. Is it such a thing as having too much diversification? Yes,
and I think the word is often diversification. So too much diversification can is a risk, shall we say? And I'd have to say it's not just in the asset class level, but it's also the number of managers that you may employ in a specific asset strategy like Australian shares. At one stage, this is going back 10 years, maybe I shouldn't say it, but I will. We probably did have too many Australian share managers. We had 9. Well, that's substantially less than what we had. We've got substantially less today than what we did then. So it is a risk, and if you add too many building blocks to a portfolio, you can just over dilute the return potential that from other parts of the portfolio. So it's a very, very interesting question that could be talked about a lot longer than perhaps what we've got time for today. But the short answer is yes, you can over diversify.
There you go. That's a good answer. We'll have one final question, and I think it's a good one to end on, which is, what is your outlook for the next 3 to 5 years, and where do you see opportunities for investors?
Well, look, unfortunately, I dropped the crystal ball in the foyer of your building, and it's shattered, so I can't answer that. No, I won't say that at all. Look, in our general in most of our portfolios where we have discretion to move the asset allocation around, I would have to say that we have been for some time, and I think we will continue to be fairly defensive in the way we're managing those portfolios. So we're cautious. We've seen this extraordinary rally in global bonds to historic low yields. So we think there are parts of the bond market that look very overvalued. There are parts of the share market that also look fairly overvalued also. And you could also perhaps add that some infrastructure assets are looking fairly fully valued as well. So rightly or wrongly, we feel in such an uncertain environment that risk management is probably taking precedence in our mind over generating very high returns. We obviously want to generate returns, but we're always assessing the risks associated with generating those returns. And in some aspects, some parts of the investment markets, we don't think it's worth exposing our investors to those sorts of risks. It might be high return, but if it turns south or you don't get what you're expecting, it could be quite nasty.
Well, thanks for answering all those questions, John, and sorry listeners for anyone who did ask a question that we just didn't get enough time to get to. We'll end the webinar there. John, thanks you again.
Thank you, Liam. Thank you for having me.
Yeah, joining us today. Really good presentation. Listeners, thank you for joining us. Just a couple of reminders before we go. advisors, there is 1 CPD point available for attending, and this is being recorded. And the webinar recording and the CPD point will be emailed to you all within the next week. And MLC is an asset manager, and some of the investments they look after include on our menu Antares, Redpoint, Fairview, Intermediate, and Altrinsic, and you can find them all on our Compare Funds and Models page on our website. So just go up to Personal in the top bar and search for Resources and Tools, and you'll find Compare our Funds and Models page. And if you want more portfolio construction insights, I highly recommend you check out our podcast series. John will be staying with us to record an episode just after, so keep an eye out for that in the coming weeks too. And finally, some of you may know at Netwealth are passionate about improving financial literacy for the next generation. So if you have a kid or would like to improve financial literacy in schools, in Australian schools, check out our partners, Banker. We sponsor them. You can get it in a classroom for free on us by referring a teacher. So please, we'll include a link to that in our post-webinar email. Finally, once again, thank you for joining us. Have a great day, and we hope to see you for our next presentation. Cheers.